Hi everybody, this is Ellman, the Blue Collar Investor, with today's covered call writing question of the day. Today's question comes from Robert S., who asks, Alan, I purchased RTN and sold the April 57.50 strike price. A few days later, 2 of my contracts were assigned very early. Here are the statistics on March 28th when the shares were sold. The price of the stock was trading at $58.79. The bid-ask spread for the 57.50 call option was $1.19 bid and $1.30 ask. Do you have any insight as to why the contracts were sold and assigned and sold so early? Well, Robert, you ask a good question because most of the time, contracts will not be assigned until the day after expiration Friday if the price of the stock is 1 penny or more higher than the strike price. However, there are some rare exceptions to that rule. And the main exception is when there's going to be a dividend distribution and the time value of the option premium is less than the dividend about to be distributed. In that case, the chances of early assignment are greatly enhanced. So let's first take a look at the trade as you've described it in your question. You purchased RTN and sold the 57.50 call option. On Thursday, March 28th, RTN was trading at $58.79, leaving the strike $1.29 in the money. So the intrinsic value of that premium would be $1.29. The bid-ask spread was $1.19 to $1.30, meaning that there's virtually no time value component to that option premium. A sure recipe for early assignment. Now, because the main reason for early exercise is a dividend distribution, we check to see if in fact there is one for RTN. And as it turned out, as you'll see in a moment, there is a dividend distribution coming up of 55 cents per share, and the ex-dividend date for that distribution is April 1st. Now, Thursday, March 28th, turns out is the day before Good Friday. So the markets are closed on that Friday and then the next 2 days for the weekend. So the next trading day after March 28th turns out to be Monday, April 1st, the ex-dividend date. So if the option holder wanted to take control of your shares prior to the ex-dividend date, you would have to do it on Thursday, March 28th. Let's now focus in on the options chain, again, as you described it, on the day that your shares were sold. So here you could see the price of the stock was trading at $58.79, and we've highlighted the 57.50 strike price, where the bid-ask spread was exactly as you stated it, $1.19 to $1.30, leaving intrinsic value of the premium at $1.29, or virtually no time value. You can also see on the right-hand side that there's open interest of 1,929 contracts, meaning that it's a very liquid option, and that's also one of the characteristics of an option that has little time value and the better chances for early exercise. So when we went to check out whether or not there was going to be a dividend distribution, here's what that page looked like. And you could see at the bottom right-hand corner that the ex-date for that dividend distribution was in fact Monday, April 1st. And if we look further up, we could see that the dividend rate was $2.20. And that's an annual rate, and if you break it down quarterly, it comes out to 55 cents per quarter. So the option holder had an opportunity, instead of selling the contract for, let's say, somewhere between $1.19 and $1.30, he was able to capture intrinsic value of the stock itself of $1.29 plus an additional 55 cents per share for the dividend distribution. A very astute move for the option holder. However, if you look at this trade through our eyes, the covered call writer, you, Robert, have maxed out your trade for the month. You received your premium, and you're able to sell the shares at the strike price that you agreed to sell it for. So congratulations for that. So this is an example where both the option seller, us, and the option holder made out quite well with this trade. So again, congratulations, Robert, on an excellent trade. And thank you so much for this question, because although it doesn't come up very often, it will come up from time to time, and it's important that we, as covered call writers, understand the scenarios when shares may be sold early. So thanks to you, and also thanks to all of you out there who are watching this video. I appreciate it very much. I hope you found it useful. And as always, this is Ellman, the Blue Collar Investor. Take care, everybody.